My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to help you make a little money. My job is not just to entertain you, but to educate and teach you. So call me, 1-800-743-CNBC. Tweet me at Jim Cramer. I hate rooting against the U.S. economy, but that's what the bulls have to do going into tomorrow's non-farm labor report. We're so obsessed with what the big picture data might mean to the Fed that it even controls the action during the single most important week of the earnings calendar. Fortunately, today went our way with the Dow gaining 322 points, the S&P climbing 0.91%, and NASDAQ jumping 1.51%. But I think that's because we could breathe a sigh of relief that the Fed meeting was now behind us, or else we wouldn't have gone up. Why do we have to hope that tomorrow will bring a weak employment number with fewer jobs added, more modest wage growth? Because after today's beautiful absence of what we call macro numbers, the Fed obsession will start anew. Should they have left the door open for a raise? Should we have signaled a cut? It's all we talk about. Think about what happened yesterday and today. Let's start with the AM before the Fed meeting broke up. We had a not-so-hot market. It was pretty ugly. Why? Not earnings. No, we were down because people worried that Fed Chief Jay Powell might lower the boom on the stock market by saying something hawkish. There were rumors that he might indicate he favors raising rates, not cutting them. This new narrative alone is an incredible thing. We're once again hostage to everyone's worries about the Fed, which is another way of saying everyone's worries about inflation. There have been some moments where we see a consumer price index number that's boosted by one or two items, and it makes for a whole overpowering wave of pessimism that takes down everything. Doesn't matter if that thing is just insurance or utilities or rent or food. Whatever line item impacts the CPI, it's going to drive down a stock like Microsoft, largest company on earth, to ridiculously low levels right before it reported. One of the best quarters I've ever seen. It actually reversed all of that gain. Every day, practically every stock is caught up in this weird notion where we hang on every piece of macro data, every public statement by a major Fed official, regardless whether the company itself underneath the stock is impacted. Even when Apple reports a better than expected set of numbers after the close, like it did tonight, sent the stock higher in after-hours trading. I have no idea how long that can last if we get an overheated employment reading tomorrow at 8:30. Wall Street was terrified that Apple iPhone sales would collapse, especially in China. And while they weren't great, down 10%, it could have been a heck of a lot worse. Hey, it doesn't hurt that CEO Tim Cook predicted a return to revenue growth in the current quarter, along with an additional $110 billion buyback authorization. I think there's a lot to like here. You know, I say own it, don't trade it. But that only matters on days where the big picture data let it matter. If it is up as big tomorrow as it is in the after hours now, it will only be because the non-farm payroll number was a cool one. Oh, I hate this dynamic because it makes us feel like companies have no control of their own destiny, and we don't have any control of our own portfolio. Everything seems hostage to which macro numbers the Fed really cares about. And we keep hearing that they care about this one, this one, this one, that one. Tomorrow, we get the all-important labor report. And if you're bullish on stocks, you actually need to show that lower wage inflation and less job creation are here, because that's what will ultimately allow the Fed to cut rates. And that is what this market is about. Nobody liked this kind of market. No, I've never seen anything like this. Let me give you a real-life example of what I'm talking about. And why a lot of people are parking their money in two-year treasuries with yield almost 5%, because it makes sense. I want you to compare that to Amazon. I follow Amazon like a hawk. I like to say that I know Amazon better than most people on Wall Street, possibly including the analysts who solely focus on this one company. Amazon has dozens of data points that go into the quarterly report, but there are a couple that really matter. One is the growth rate of Amazon Web Services. It had been decelerating for some time, and that was beginning to impact the earnings. They told us things could get better. I know I fought them on this because I was really worried, but management presented evidence that my view was wrong. They turned out to be right. Amazon Web Services once again growing like crazy. That's so important. It's lucrative, very lucrative. The second issue was the seemingly endless losses in Amazon's international business. Next thing you know, it's actually profitable. Third, we need to see the price of packages keep coming down while we got a preponderance of same-day fulfillment. You know what? We got what we wanted. 3 key metrics, 3 home runs. But Amazon had the misfortune of reporting the day before the Fed's press conference. So those blowout numbers ended up meaning very little to the share price yesterday. Amazon's stellar performance was a nothing burger until Wall Street got over its worries about Jay Powell's next move. Today, once we're past the big bad event of the Fed, so Amazon could rally more than 3%. And you know what? How long that's going to last? Until the employment number tomorrow. Now, the Fed meeting's always been an important event, but the constant obsession about it is a new thing. Some of it's the fault of the Fed. In a misguided bid for transparency, they've created a monster. Jay Powell doesn't need to hold a Q&A session after every meeting. He's chosen to be like the flying Melendez, doing a high-wire act without a net. That's an extremely risky maneuver that he has chosen. Jay didn't need to say that we're perhaps done raising interest rates last year. Think of it. Employment's incredibly strong. As long as we have strong employment, the Fed had no business taking more hikes off the table. Powell was so fixated on all sorts of data points, but all he should have been thinking about was employment. Because the incredibly robust job market is the whole reason why we have inflation in the first place. People without jobs are a lot less likely to spend or buy cars or homes. Less spending is what allows prices to come down. I wish there were a better way to do it, but the only way the Fed beats inflation is by causing unemployment. Our best inflation fighters now have nothing to do with the government. They're the big providers of goods, Walmart, Costco, Amazon, with the latter actually being shunned by federal regulators because the Biden administration is reflexively skeptical of any business that they see as being too big. Amazing. Without any help from our elected leaders, all we can do is accept our fate from one tool, the Fed funds rate, to control inflation. Which brings me back to rooting against the American economy. If our sole tool to combat inflation is the federal funds rate, which is set by a committee of people who often disagree with each other in public, people who can't seem to keep their mouths shut, then the whole stock market ends up being a plaything for people who want to make bets on the Fed's next move. Or to put it another way, we all know that every single point gained today can be wiped out by the wrong employment number tomorrow. And right now, wrong means stronger than expected. It's absurd. It's the opposite of a stock picker's market. I remember at one time when stocks traded on the basis of how the underlying companies actually did. Then we started considering their sector more. In the old days, sector only controlled 50% of the action in a given stock. Then so much investment became passive investment coming in the market via index funds that the S&P 500 became the most important portion of the value of a stock, with sector second and actual performance becoming third. Now, because the S&P's price direction is determined by the Fed, then an individual stock price is largely determined by the Fed, too. And everything else is subservient to it, which means if the economy weakens, your stock, regardless of its sensitivity to the economy, goes higher. I'm sorry. They know nothing! Bottom line, we often get bad news as good news moments at this point in the business cycle, but it's rarely as excessive as it's been lately. I wish the market didn't work this way, but that's the reality. And it's why you need to bet against the U.S. economy tomorrow if you're hoping for higher stock prices. Let's go to Max in Missouri. Max.
Hi, Jim.
Max, what's up?
We all appreciate everything you do for us.
Thank you.
I'm in a major house of pain on a company you've basically been in the hold camp on, even suggesting at one point they were a potential takeover candidate. For the mid to long term, what is your outlook for Etsy?
Okay, Etsy's executing not well. And I say that because when you read the conference call, they tell you they're not executing well. And it is difficult for me to figure out what they can do. I have been a backer of Etsy. I think it is a good company, but I just don't know how they can fix the darn thing. It's got great customers, it's got great loyalty, but it's just not working, and I don't know what to do other than to say that I still like it, but I have been wrong in liking it. I believe it's a good company, and I don't know how to fix it. Let's go to DJ in Colorado. DJ.
Hey, Jim, I'd like to send out a huge booyah!
Very interesting.
Lovely Redstone,
Very interesting.
Colorado.
All right, what's up?
Hey, Jim, I've always loved your wit and your spontaneity, as well as your obscure literary and cultural references.
True.
And the way you stump the guys in the morning show, which is why I want to ask you about SG, Soylent Green. No, just kidding. The stock I want to ask you about has one of the lowest PE ratios of all the energy stocks at just below 8 with a forward PE of just above 9, which also makes it much lower than so many of these tech stocks with crazy valuations. The stock's had a little bit of a pullback lately and could be a good re-entry point. The stock is Valero.
Yeah, it had a pullback. It's interesting. Marathon P had one, too. I think you're right. I think it is an interesting level to do it. They're going to make a ton of money. People feel it's just obviously just a commodity. I understand that, but I do think you have a winner there, and I would buy it. Let's go to Robert in New York. Robert.
Jim, what can I say? I haven't spoken to you in a while because you've made me so much money that I've just been relaxing a little bit here and there. But I'm ready, and what you have done for people is incredible. And you have.
Thank you.
I mean, I want everybody out there in Cramerica to realize that when you said I remember exactly what you said about AI, and you said pull a little off, and you were dead on. You were not wrong. You were 100% on the mark.
Thank you, buddy.
Okay?
Thank you. I really appreciate that. Thank you.
Thank you. Anyway, Jim, last quarter, this company reported $648 billion in revenue, in line with analyst estimates. Although statutory EPS of $1.91 beat estimates, being 5.6 higher than what the analysts expected. They're closing 160 of their Village MD clinics, which they invested over $5.2 billion. This company is Walmart's.
Look, they made the tough decision, and it was the right decision. Unlike so many other companies, they are not afraid they've made a mistake. I really value that. It's one of the reasons why I think Walmart is a very strong and solid buy. If we didn't own Costco for my charitable trust, people know that I would own Walmart. Okay. Look, it's a bad news is good news moment in the business cycle. While I hate rooting against the U.S. economy, it's what the bulls must do going into tomorrow's job report. On Mad Money tonight, Brinker, the company behind Chili's and Maggiano's, hit a 52-week high earlier today before pulling back into the close. But given that the company's in a tough sector, should you consider nibbling at the stock still? I'm checking in with the CEO. Then Viking came public yesterday in the largest IPO of the year. So do I think the stock can continue to sail higher? I'm going to give you my take. And DraftKings reported after the bell, and I've got the post-earnings exclusive with the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.